the informed investor. Thanks to Century 21. Smarter, bolder, faster. Go to century21.com.au.
Charles Tarbey is the chairman of Century 21 Australasia. He joins Steve each Monday to take your calls on property, buying, selling and investing, and how to make the most from real estate. 131 873 is the number. Chris Kenny here sitting in for Steve Price on nights. Good evening, Charles.
Good evening, Chris.
Look, pretty interesting news around the place in the last few days when it comes to property markets and property prices. Melbourne has followed Sydney now in recording its lowest auction clearance rate in 6 years. Is that surprising,
Actually, yeah.
or is it partly to do with the fact that it was a long weekend?
I think, look, long weekend certainly has a lot to do with the numbers, Chris. And the auctions in Melbourne were generally up in the 900s to over 1,000. There are only 276 auctions this week. But it still gives you an indication of what's happening, because this time last year, they had just over 300 auctions in Melbourne, and the clearance rate was 75.6%, whereas this week it was only 56.1. That's like a 20-point difference. So I still think if you're matching the numbers, that's a very strong decline in clearance rates.
What happens to those properties then? They end up selling for less than owners want, or they hold on them for longer? What does it do to the market in the medium term?
Yeah, it's an interesting marketplace. Actually, general real estate, we're just back to where we should be, and that's sometimes properties take a little bit longer to sell than others. People's motivation is as strong. The urgency to buy or sell and buy isn't as strong, and I think people do sit a little bit longer on properties. There are properties, as you get outside of capital cities, Chris, there are properties that have been sitting on the market for months and months on end. So I think we're just coming back into that standard real estate market where that urgency has disappeared and people start negotiating on a much more even platform.
And a new report has found that 2/3 of women with a mortgage think they'd run into hot water if their payments increased by just $100 a month. Now, that's not much of a buffer, is it? How much of a buffer should you have when it comes to mortgage repayments? Remembering, of course, we've got some of the lowest interest rates we've ever seen. And if you get just a 1% increase in mortgages, in some cases, that's going to increase your mortgage repayments by 20 or 30%.
That's correct. That's correct. And this is something that we've been chatting about for quite some time. People have sort of forgotten about, because interest rates have been on hold for so long, and it still looks like they're going to be on hold for some time.
Yeah.
And so nobody has paid a lot of attention to it, and that's the worst part about it. You only need a small increase. So I always tell people, if the interest rates were 10% and they went up to 11%, that's only a modest increase in terms of adjustment. But if you go from 4 to 5, it's a massive increase. And people haven't adjusted to that. And this is of great concern. This is why the RBA were all over people recently with fixed loans. They were saying, hey, well, you're not making any reduction on your debt. And as you come out of those fixed loans, the interest rates could be, instead of 4, they could be 6. And you could be in a lot of trouble. You haven't made any debt reduction. You haven't got any equity gain. And the banks are going to look at you and say, hey, well, we don't want to lend you any more money. And that is an issue that people really need to focus on right now. Debt reduction is critical, and preparing yourself for change is critical as well.
So how do you quantify what an appropriate buffer is? Presumably you've got to be able to handle mortgage increases of up to 1% over a period. Is there a rule of thumb you've got compared to your income that you should try and build into your finances to protect yourself?
Now, it is a good question, and Chris, they generally have a rule of thumb it's all gone out the window in the last few years because of the changes in the market. But what's more concerning about all of this, and if you're an investor, you should always have, at least in my view, at least 3 months backup in there, because you might lose a tenant for that period of time. But what's become more of a critical factor is the Royal Commission into Banking. That has changed the playing field so much, and again, one of the things that we've noticed very, very strongly, and Steve and I spoke about this last week, is that no longer having equity is enough anymore. Just if you owned a property where it was worth $1 million and you had $500,000 in debt, that doesn't mean you can borrow any more, because unless you can demonstrate the ability to
you still got to service that debt.
It's all changed, yeah. I mean, when I was buying investment properties years ago, it was all about equity. It wasn't about repayment. The repayment issue was my problem.
Yep.
As long as the bank had equity and they could sell me out, if they needed to. That's all they were concerned about. Well, this Royal Commission of affordable lending, all of this has changed. APRA have been so heavily involved in the housing market, and now with the banking inquiry, I've never seen so much focus and intensity on bankers to do exactly what they have to do by the book. Absolutely little or no flexibility at all.
Charles, just a couple of issues that have been in the news lately to get your input on quickly. One is all the growth in Melbourne. We're talking about massive growth in the population of Melbourne. What are the current hotspots when it comes to building?
Yeah, the best spots in Melbourne nowadays are certainly south of the city and around the bay on the other side of the city, around Point Cook and those areas. Those are the two spots that have been undervalued in my view. You go all the way down to Frankston as an example, and you could buy properties, beautiful properties. Frankston's got an odd mix of properties from right to the bottom to the very top, and you're sitting near the ocean, but you're paying prices, or you were paying prices there that were so low. And I think there's a tremendous amount of opportunity for growth in the Melbourne market, because whether you're going around Point Cook all the way down to Geelong, or you're coming around this side down Dandenong, Narre Warren, all of those areas, there's so much potential for growth. And Melbourne, as you know, is a wonderful city with an incredible lifestyle opportunity. And I think that pricing there has made it more attractive because Sydney has gone so crazy. Yeah,
the other thing I'll perhaps try and leave for Steve to talk to you about next week is the possible new laws in New South Wales when it comes to short-term rentals, Airbnb and the rest of it. A lot of people investing in those areas lately, Charles, and a lot of change on the way.
Yeah, a lot of people have been scared off with Airbnb because of short-term stays, because of issues related to people coming and partying very heavily in some of these places. And
absolutely. We'll have to take up those issues next week, I think, Charles. As you say, a lot of problems and some legislative changes on the way. Thanks very much for joining us, Charles Tarbey, who's the chairman of Century 21 Australasia.
A smarter SMSF solution is BillDirect. Invest and view your trading and super admin all in one place. Plus, BillDirect takes care of the paperwork, compliance, tax and auditing. They're different, with online data reporting, a mobile app and concierge service, so you can talk to a SMSF expert every step of the way. Set up your SMSF with BillDirect by June 30 and save $1,455 in your first year. Visit BillDirect.
Before investing, consider your financial situation, needs and investment objectives. Terms and conditions at belldirect.com.au, AFSL 314341.